Hello, clients and friends of MBP Sterling Partners. It's Jamie. I am back with another quarterly update. This time we're going to be looking back at what was in Q2 2025 and what the rest of the year will bring. Firstly, the themes so far that we've seen in the year are, of course, uncertainty. Policies bouncing around back and forth, announced, rescinded, delayed, announced again, and coming back again. This has been the course for the year, and it's caused a wild rides in the market. It's also caused a decline in the US dollar, although we'll get into some of those dynamics and whether this truly was a cause of the policies or not. And of course, in the equity markets in particular, where we focus a lot of our attention, what a wild ride it has been. So let's take a look at those numbers. Funnily enough, it's green across the screen for equities. For all the noise and the uncertainty that surrounded the market so far this year, it has been actually quite a good return for most equity markets around the world. We would note that the US is actually lagging most major markets. And for those of us in Canada, and in fact in any country other than the US that has to convert their returns back to local currencies, it has been not a great ride. But that, of course, comes after a pretty phenomenal 2024. So looking here at the quarterly, year-to-date and one-year returns for equities, you can see Canada is actually amongst the leaders for year-to-date, along with Europe. The performance so far has been quite robust. On the bond side of the ledger, not terrible. We've seen bonds holding their own, not delivering great returns, but also not declining. That's due to the interest rate picture that we'll get into a little bit later on. On a theme that we've been looking at for quite some time, the rest of the world's performance versus the US, we did see a brief period of rest of world outperformance versus the USA. However, it was brief and the US has resumed its dominance. On a longer term, you can see on the right here, the US has now been dominant for quite some time, but when we look back long enough, and in this chart takes us back 40 odd years, you can see that there are long periods of US outperformance and US underperformance, or in other words, non-US outperformance. And so we wouldn't be surprised to see that switch. The catalyst for that type of switch is usually some global economic change. Most recently, we saw a big commodities run that helped a lot of commodities producers like Canada outperform the US. What will lead us forward? We're not quite sure yet, but this is something we're watching closely given the strong performance, particularly out of Europe so far this year. Another theme we've looked at a lot is the cap weighted versus equal weight. And in other words, looking at what the Magnificent Seven are doing. Cap weight briefly took a pause and equal weight caught up during the correction that was at the end of Q1 and beginning of Q2. But we are back to cap weight and the majors outperforming an equal weighted index. But we'll stop for a second. Here's the Mag 7 in the bottom right. Maybe it's not Mag 7 anymore. Are we potentially looking at Mag 5 or maybe even Mag 4? Who knows what the next acronym is going to be? But we would know that there is divergence among these stocks that we've been talking about for so long as being the stalwarts of the US market. In terms of rates and currencies, these are the 5 and 10-year long-term Canadian and US interest rates. And you'll notice that while being range-bound, for the last quarter, we've seen US rates generally declining. This is true for everything except for the long bond, the 30-year bond, which is about flat for that period, and Canadian rates slowly edging their way higher. Now, this is playing out in the currency market. And as anyone who's listened to one of our outlooks before knows, interest rate differentials are something we watch very closely for the level of the Canadian dollar. And even though we haven't had any movement in the overnight rates, the bond rates in the longer term, so 2, 5, and 10 years, have actually been converging. So what have we seen in the currency markets as a result? Well, we all know that story. The US dollar has had a really negative period of performance so far this year. Here's all kinds of other world currencies against the US dollar. You can see green across the screen here year to date. That dollar index at the bottom shows firmly in the red, down 11% so far this year. While that is a big move and it certainly measures among some of the biggest 6-month moves that we've seen, it hasn't necessarily meant that there's major market dislocations happening, and there could be lots of things at play. Notably, we would add is that the US dollar had a phenomenal performance year and years leading into this negative 6-month period. So while we look at policies as a catalyst for causing this decline, this could just be markets realigning themselves as investors rebalance around the world. How does this look versus the loonies? Well, loonies were mixed. So for all the talk about a super, super strong loonie, that is not true. If you are traveling to Europe this summer, you are going to notice that. Unfortunately, the euro is still up higher against the Canadian dollar. It's making traveling a bit more expensive when we go east instead of south. But it has been mixed against other currencies. So you'll see euro and Swiss franc leading the way against a lower loonie, whereas the yen and the Aussie dollar are roughly flat, as is the pound over the last quarter. This shows the 6-month rate of change of the US dollar. And as you can see, we're right at the bottom of this range here, a negative 10%, negative 11% performance. But as you can see, this is not that unusual. This happens relatively frequently, and we just haven't seen that necessarily spill into broader markets in the past, nor are we expecting that to happen on this case. Now, who knows? We're watching policies change minute by minute, and these are economic focused policies for the most part. So it could rock the boat, if so to speak, and cause changes in global markets. But what we've seen so far is an extreme, but not all that rare case of the US dollar falling precipitously and quickly. So testing our 2025 outlook, this is from the beginning of the year where we posited some themes that we might see. Policy volatility, of course, that continues on, and we're going to expect that for as long as the current administration is in the White House. Higher interest rates, we've gotten that right and wrong. Canada, we've seen grind higher, as we showed. US is grinding lower, so we'll give that a 50-50 score. Tariffs, immigration, and fiscal deregulation, that carries on both sides of the border, we'll note. While most of us are focusing on the US news cycle, there's been big changes to Canadian immigration policy since the new administration took over. And we are watching that closely because that could have pretty profound effects on Canadian GDP and, of course, interest rates and currencies as well. As for some of our investment themes, we won't go over them in detail here. We still think that they are largely in place. The one exception we'll throw out there is hydrocarbon-based energy, really outside of a brief period where we saw conflict happening in Iran. There has not been a whole lot of demand for hydrocarbon-based energy, and oil prices are suffering as a result of that. So let's get into the balance of 2025. What's our outlook? Firstly, let's have a look at rate expectations. Overnight rates are mostly unchanged. There's still expectations of a couple of cuts on both sides of the border, but the terminal rate expectations for 2025 remain where they were about a quarter ago. Now, this comes amongst a whole bunch more noise. So we said policy volatility. That's not the only source of noise. We do have an administration that is actively yelling at the Federal Reserve and begging them to lower rates. And in fact, I would go so far as to say threatening that they should lower rates. And so this is interesting to watch, as typically we haven't seen the policymakers in the White House openly criticize the Federal Reserve. But hey, this is a new era, and this is where we're at now. So we will see what comes of the Federal Reserve. But for now, the Fed has said that they're standing pat and they're data dependent, watching inflation and employment data as their mandate tells them to do, while the administration has been jawboning rates lower. So speaking of those policies and volatility, we found this from the aptly named Economic Policy Uncertainty Group. They chart out policy uncertainty over time, and as you can see, not surprisingly, has spiked higher. And this comes even amid this week as the US starts to send out letters to various trading partners around the world, indicating what type of tariffs they will be implementing come August. So this isn't over yet. We're going to hear a lot more about this going forward, and we expect the only thing that will end this type of volatility is once Trump's term is done and we move on to another administration. So even though those volatilities are crushing higher, what's happening in the markets? Well, equity volatility and bond volatility are both declining. These are the VIX and MOVE index, which show bond and equity volatility respectively. And you can see they have been decidedly down over the last quarter. This is coming back to the beginning, where we have indicated that the market just does not care. It is not concerned about all these new latest policy wobbles. Whether they come back and decide that it really matters in a short period of time, that's yet to be seen. The summer is still young. But for now, the market has decided to largely discount a lot of these policies that are coming out of the White House. On the outlook for the economy, we've seen Canada GDP softening a little bit. We've had two negative monthly GDP prints in the last four. So we are running at, some would say, stall speed on GDP in Canada. But that said, we've got some administrative changes and some policy proposals out of the new Liberal administration that might change that. You can see in the US, our recession probability had been starting to creep up, but has eased recently. And so this is increasingly becoming the recession that never happened. Many will recall that when the 2022 bear market was happening, most economists were calling for a recession in 2023. That never happened. And that's with the big spike in that US recession probability that you can see coming up and then easing back down as 2024 took hold and corporate profits started to boom again. Unemployment, you can see there are very different pictures here between Canada and the US. Canadian unemployment continues to grind higher, and this is the primary source of our concern, particularly because Canada is an indebted country at a household level. That employment is very important to Canadian debt service. So also probably why our rates are considerably lower than the US is that level of debt in Canada. Meanwhile, the US, you can actually see their unemployment rate has rolled over and actually ticked a little lower again. So despite concerns on layoffs and efficiency, and of course, artificial intelligence leading to a lot of layoffs, the unemployment rate in the US remains low and jobs are not that hard to find. Now, that may be changing, and it may have something to do with immigration policy where workers are being asked to leave the country. That's the polite way to put it. And those jobs are now being sought after by fewer people. So that does have an effect on the unemployment rate. The participation is a big part of that. And so it could be that that is driving US unemployment lower. But so far, US unemployment, while there's been some signs of cracking, still remains very strong, while Canadians is somewhat weaker. This is an interesting chart that we borrowed from IceCap Asset Management, which is analysts that we read and listen to quite frequently, showing Canada's research and development capital expenditures. So this, in one chart, is the productivity problem that we talk about in Canada. R&D spending, while it's remained at a higher level that it achieved in early 2000 when the tech boom was in full swing, as a percent of the overall economy has declined quite some amount. And so this is the productivity problem that Canada faces in one chart. A focus on real estate in particular, regulations that do not encourage R&D spending and capital expenditures has led to this situation. We are somewhat optimistic at this point that the new Liberal administration does recognize this and has started to bring in some policy measures to counter this and bring some investment back to Canada. These are some of the policies, or at least the summaries of the policies that the Liberal administration has been talking about to help that fiscal situation in Canada. So we're going through these and looking at them. Are they fiscally stimulative or not? And of course, we think that's very important. Fiscal stimulation, meaning government spending, often winds up in the economy and in the profits of the stock market. So it's important to see whether those governments are spending money and helping the economy grow or not. So increased defense spending, that's coming as part of the trade negotiations with the US. That's obviously stimulative. So we'll give that one a big check mark. Addressing internal trade barriers, anything for the freer flow of goods, whether they be north, south, or east, west, we think is a positive to the economy. So we'll give that a check mark. Fiscal measures, including cancellation of the carbon tax, as well as cutting bottom income tax brackets by a percentage point, we think are good. Eliminating GST on first-time home buyers is of limited use, but anytime taxes go down is good for households. So we're happy with that. The one negative, of course, is the current talk about sweeping cuts to government spending. That's good for the budget, but not good for fiscal for fiscal stimulus, so we'll give it an X. Long term, we think it's the right thing to do, but in the short term, it could be somewhat challenging as government spending is a significant portion of GDP. The elimination of the digital service tax is good for you or for Canadian consumers. Overall, we think that trade negotiations with the US will lead to a more productive Canada, even though it is not a good place to be, and we're not happy to be renegotiating a lot of these trade agreements that we had made with the US. At the end of the day, we believe that Canada can band together and come to an agreeable solution. And then, of course, there's nation building infrastructure projects. This is the big one. Building infrastructure is part of Canada trying to find new trading partners, trying to find new foreign capital investment. These are all very big things that are great for Canada and great for building a future economy. So we are all for any policy that will help to eliminate regulations and attract foreign capital, as well as get local capital invested into building again. So these are all positives for Canada. The last quarter, we called this "There's Always a Reason to Sell." This time, we want to give reasons to buy. And being invested is obviously more important than the timing of investing. And so what this chart shows, which was borrowed from Ritholtz Wealth Management, another group of analysts that we watch and read and listen to, they show us the effect of investing in the S&P 500 at an all-time high or at any time other than an all-time high. And those are the light blue and dark blue bars, respectively. The most important thing to note here is that there's no difference. Markets that make all-time highs are on their way to making more all-time highs, and markets that don't make all-time highs eventually tend to make new ones. So the timing, frankly, really doesn't matter. And this is the data going back to 1960 that shows you any day buying at an all-time high, you are just as likely to make money as a day where you wait for a pullback. So we thought this data was very interesting. We will, of course, still stand by diversification as being the #1 tool for us to protect and grow wealth, and do it in a measured fashion in a way that mitigates as much risk as possible. But we do often talk about the timing of investments and whether we should be trying to time the markets or not. That's all we have for today. Thank you so much for joining us. I hope you enjoyed the presentation, and we look forward to connecting with all of you in the future.